The US economy is on the brink of catastrophe. The size of the US economy in 2020 was about $20 trillion. Today, it has risen to over $30 trillion. So the average American should have gotten at least 30% more wealthier. But if you ask anybody in the streets of New York or LA or any other American city, they will tell you that prices are soaring, wages are falling down, and life got a lot harder. So how is it possible that the US economy is growing faster than ever, and yet the life for the average American got a lot more harder? What exactly is going on? The truth is that the US government has quietly been hiding a stagflation, and that is the worst thing that could happen to any economy, even worse than the Great Depression of 1929. If you think that I'm exaggerating, let me show you the facts. Meanwhile, give this video a thumbs up and let's get right into it. The Great Depression of 1929 should not have happened in the first place. It was a man-made crisis. In fact, prior to the 1929 Great Depression, the US economy had one of the best periods in its entire history. When World War I happened in 1914, the Allies were fighting the Central Powers. And while these two countries, or these two sides, I would say, were fighting each other, the United States was making a lot of money by selling stuff to the Central Powers and the two Allies. The United States was getting richer, while those countries on both of these sides were getting significantly poorer. There wasn't a single sign of economic crisis. So how is it possible, after such a great period of economic prosperity, the United States faces probably the worst crisis in its entire history? When the US economy began growing so fast, the average American became the wealthiest citizen of any other country. The consumer market in the United States became the largest consumer market in the world, and the average American started investing. The stock market was growing faster than ever, and a lot of people got delusional. A lot of people wanted to make a lot of quick money out of the stock market when they didn't understand how the market worked. So people started borrowing money, investing in the stock market, and asset prices were inflated to levels that we haven't seen prior to that. So the market turned into a bubble and it collapsed in 1929 because the market wasn't actually backed by real earnings. And it's very normal for the stock market to crash because when prices are inflated beyond what they're actually worth, there will be a correction and prices are going to fall down. So the government should have left the economy to do its thing. However, it quickly turned into a domino effect. Since most of those investments were on debt and the entire economy was over-reliant on debt, bank failures became a normal. So if you borrowed money to invest in the stock market, now you cannot pay off your debt to the bank. What do you think is happening to the bank? The bank has failed and declared bankruptcy. People got into panic and they went to other banks to take their money out of those banks. And very quickly, most of the banks in the country began declaring bankruptcy, which worsened the entire situation. That led to a huge wealth inequality. Even though that the United States was the wealthiest country at that time, even today the United States is the wealthiest country in the world, most of the wealth was concentrated in the top 1%, while the vast majority of people either lost their investments and there was a huge unemployment in the entire country. You see, this is how the economy works. The true size of the economy is the true output of the economy and the true productivity, what exactly the economy can produce. Cars, steels, technology, or whatever. Multiply that by the prices within the entire economy and you have your GDP, or the size of the economy. This is a simplified version of how we can actually imagine the entire economy. When you have a bubble, when prices are rising faster than the output and the productivity, what do you think is going to happen? Sooner or later, there should happen a correction, so prices fall down. And that's exactly what happened in 1929 when the stock market collapsed. So the government should have left the economy to do its thing. The government should have left the free market to do its thing. The market is overvalued, now there is a correction and prices are falling down. It's okay. Let's just let the economy over time increase the productivity to match the prices. Even if the prices are falling down, now they will continue rising because we're increasing the productivity. But the government decided that We have to protect American businesses. We have to protect American companies from outside factors. Those European companies, those European nations are competing with the US companies. If we stop those companies from coming into the United States and out-competing our companies, we might solve the Great Depression. So the government passes the Tariff Act of 1930. What do you think that have done in the economy? Suddenly we increase the tariffs. Those countries on the other side of the ocean have also increased these tariffs in retaliation to the United States. Now, think about it for a moment. What made the US economy the wealthiest economy in the world isn't because the United States was isolated from the rest of the world, but rather it was because of globalization, but rather because the United States was selling to the Central Powers, to allies, and to the rest of the world, which made the United States such a wealthy economy. Now you have imposed the tariffs and you're not allowing these countries to trade with you anymore. What do you think have happened to the size of the US economy? It went down. And that's why tariffs actually worsened the Great Depression. In fact, tariffs made a normal economic crisis into a Great Depression that lasted for the next 10 years. But gladly, the next president of the United States was Franklin Roosevelt, and he understood that the first thing that we have to do is get rid of all of those tariffs so that the US economy will start trading with the rest of the world, and over time the US economy is going to grow. But that was not enough. The government decided that we need a new actor in the economy. So Roosevelt came out with the New Deal. The point of the deal was that the government is going to intervene massively into economy by introducing a lot of government programs such as Social Security. That huge government spending is going to boost the economy and will help it to grow. Because besides people within the entire economy, besides the companies, besides the banks, now you have the government that has trillions of dollars, at that time billions of dollars, that it can throw it into the economy and create that demand and lift the economy out of the Great Depression. The economy began to recover, and then World War II happened. That gave the United States another opportunity to sell massively to the rest of the world and become the dominant power in the world. And now compare that to what's happening today. We have a hidden crisis that is way worse than the Great Depression. You see, financial crises are a fundamental part of the economy. The economy starts to grow, then it reaches a certain peak and there is a crash. Suddenly, prices adjust and productivity starts to grow again or grow much more than it was prior to that, and then it reaches a certain peak. So let's go back to our basic equation. The only reason that the economy reaches a certain peak and then crashes is when prices starts rising faster than the productivity. If prices are rising and the entire economy and the output of the economy is also growing, then the true size of the economy is also growing, which is great for the economy. Even if inflation is 5%, but the output in the economy and the productivity is growing by 10%, then the real growth of the economy is actually 5%. So even though that inflation on one side is high, the true size of the economy is growing and the well-being of people is also growing. The problem comes in when prices are growing way faster than the output of the economy. So let's take this equation and compare it to what's happening in the world today, or with the US economy. The US GDP is growing between 2 to 3%, or has been over the last couple of years. Now it has slowed down to less than 2%, but over the last couple of years, the growth has been around 2 to 3% adjusted to inflation. Inflation at the same time has been at around 3%. Based on this data, the US economy is doing great. The US economy is actually growing. So the question is, why people are complaining? Why people feel like they got poorer? Why do people complain that prices are rising while wages are falling down and life got harsher? The problem is that this data that the government is presenting to us is absolutely false. The real question is that maybe the GDP growth they're presenting to us is correct, but are inflation numbers that the government is providing to us with the CPI report is correct? That's what we have to find out. Because if GDP grows, let's say, by 4%, and CPI, the real CPI is, for example, is also 4%, then the economy hasn't grown at all. But if we find out that the real CPI is actually 10%, then prices are growing way faster than the productivity, and that's what we call stagflation. So how exactly inflation is measured? Now, we have different metrics to measure inflation, but over the last 50 years, the government has been tricking the numbers in such a way so that they bring the inflation number down and down. Back in 1970s, if you pull out the CPI, they used to actually include home prices or mortgage rates. So if house prices, for example, have increased by 10%, then it will go to the CPI report as 10%. Some people might say, well, the vast majority of people in America buy their houses with a mortgage, so it makes sense to include mortgage rates instead of house prices. That's what they have done. If mortgage rates have increased, you would make that part of the CPI. But then they realized that actually increases inflation too high. So let's remove house prices, let's remove mortgage rates, and come up with a different metric that will kind of represent the cost of shelter, but it doesn't represent exactly house prices. And suddenly, inflation numbers have dropped dramatically. And that's why, for example, the vast majority of Americans spend at least a third of their income on shelter, or sometimes even half of their income on housing. House prices increase by 30%, but then you see that inflation is increased by 6% or 2%. It doesn't make sense because they have taken those numbers out of the real inflation numbers. Back in 1970s, food and energy had heavier weight on the CPI. Now, if you take an average American family, you will see that most of their income either goes to housing, food, and energy. That's like 80% of most people's expenses. And back in 1970s, food and energy had a much bigger impact on the total CPI. Today, it has a much smaller weight on the total CPI, which brings the total CPI way lower than its actual CPI that's supposed to be. Another major change the government has done. If the product, for example, increases in price and they have actually made the product better, then it's not considered inflation because they made the product better. Take, for example, a car. Next year's car becomes better and the price increases. Based on the CPI, the price of that car hasn't increased because they simply made the car better. Or if they improved the car but kept the cost the same, based on the CPI report, we had a deflation. If Apple comes up with the new iPhone and the price of iPhone is the same as the previous year at $1,000, but it has a better camera, based on the CPI report, we had a deflation and the real price of iPhone has actually dropped. So this year they have introduced the iPhone 17 Pro and its starting price is $1,100. Now, based on the CPI report, the price of iPhone hasn't increased because the iPhone 17 Pro, yes, it costs 10% more expensive, but it has better features. So technically the real price hasn't increased. So they started tweaking the numbers. They started playing around with the numbers. They started manipulating the numbers over the last 50 years to bring the real inflation numbers way below than the actual inflation. And that's why if you take inflation in 1970s, you can easily see an inflation of 8%, 10%, 12%. Last 20 years, you take the inflation numbers, it's about 2%, 3%. That's not because the real inflation has gone down. That's because the government has manipulated the numbers so that the numbers that you see on inflation are way below than the real numbers. And that's why, for example, over the last 5 years, most people have seen that the quality of their life has gone down, that prices have soared way higher than the reported inflation. But inflation at the end of the day, 2.8%, 2.9%, and this year it will be 3%. If we use the metrics that we used back in 1970s to measure inflation, then the real inflation rate today is at least 2 to 3 times higher. The GDP is growing at 3% and the real inflation is anything between 6 to 9%. The government does not want to call it a stagflation because the government wants to continue using the new methods by manipulating the numbers so that you don't feel that we have a stagflation. Because if we have a stagflation, this is an economic disaster for the vast majority of Americans, and real actions must be taken to change everything. The economy cannot sustainably grow when there is a stagflation, because with each consecutive year, the average American is going to get a lot poorer, while the top percent knows how to get out of it, because the top 1%, they have real wealth. Their money is invested in places like the stock market. And that's why asset prices are rising dramatically fast and the market is not crashing. The average PE ratio for the S&P 500 has grown to 30. That is twice the PE ratio of the average S&P 500. Why the market is not crashing? Because there is massive inflation in the market and rich people want to preserve their assets. They want to preserve their wealth. If they keep their money in cash, then they lose money every single year. So they keep investing in the stock market because there isn't any other place to keep your money. There isn't any other place to invest your money. What is the solution? What are we supposed to do? How can we fix the economy? Well, there aren't many options. The first option is, of course, to increase the productivity massively. So we grow the economy so that it matches the current prices in the market. If we can do that, then we have to decrease the prices. Now, lowering down prices in the market makes no sense on one side, but it actually happened multiple times throughout the entire economy. Between 2000 and 2008, house prices grew dramatically fast to the levels when in 2008, everybody realized that house prices are inflated and the government let the market crash. So house prices lost 30% of their value, 50% of their value, and in some cases, they went as low as 70%. The second option is to increase massively the output, such as like it happened back in 1933 with the New Deal. The question is, can we afford any of those options? Well, government is already overspending. The government is already running a $2 trillion deficit. How much more the government can spend? The US government right now does not have the ability to borrow more money because it has already overborrowed and over-exercised its power to borrow as much money as possible. The second option is the Federal Reserve to intervene, but that's also not an option because the balance sheet of the Fed is at $6.6 trillion. And the chairman of the Fed made it clear that we have to empty our balance sheet. And this program will continue for the next at least 3 years or maybe up to 10 years until the Federal Reserve will bring down its balance sheet to pre-COVID level to around $4 trillion. So we don't have that option as well. The third option is to let the entire market crash. But that's not also an option because the United States is in a competition with China. If the US market collapses right now, then the US will have the same GDP as China, and China could possibly overtake the United States as the world's largest economy. Now, the question is, how do you want to have the global reserve currency when you don't have the largest economy in the world? So that is something that the United States at this point cannot possibly afford. So what is going to happen next? Well, let's go back to our equation. The government will try every possible way to increase the productivity. It will do a lot of stupid mistakes, such as imposing tariffs. I am more than confident that in 3 to 4 years from now, all of these tariffs will be completely removed. Or the government will start massively spending to do something, either to boost AI, to boost technology, to somehow grow the US economy. That might not always work, but it will certainly keep increasing prices. So the GDP is going to continue rising, prices will continue rising, and you will simply get poorer every single year unless the real size of the economy is going to grow. Unless you take a portion of your money and start investing in the right assets. I mean, I will keep saying the same thing. I will keep telling you that you have no way out of this unless you are invested in the right stocks, in the right assets. The problem with investing is 90% of people who invest in the stock market end up losing money because they don't know what to buy, what to sell, and even if they end up buying the right stocks, they will end up selling them at the wrong time because they don't understand how the market works. They don't understand how to analyze stocks. They don't understand how to get into the right position in the market. So, If you want to know what are the top 5 stocks to buy right now, then check out the first link in the description of this video. That's it for today, guys. Thanks for watching, and I will see you in the next one.